One of the best skills you can have as a trader is being able to generate high percent return based on the amount that you're risking. So if you're risking $100 and if you're able to walk away with 200 or 250, that's a very, very good return. So in today's video, I'm gonna give you guys a masterclass. I'm gonna do a trade recap. And in that trade recap, I'm gonna show you guys how to trade SPX, the benefits of strike selection, and how you trade SPX based on if you have a smaller account. Let's get into it. So if you guys take a look at this trade I took on SPX, all right, this was on May 29th. I did Zero-DTE. If you guys are not familiar with Zero-DTE, that means that strike that I chose expires that particular day. Now, just to give you guys a quick breakdown of for what that means, strikes that expire the same exact day, they typically lose value very fast because you have limited amount of time until those contracts expire for that day. That's called Zero-DTE. For SPX, SPY, you have Zero-DTE every single day. For other stocks like Tesla, Nvidia, and so on, these expire every Friday. Now, just to break down this trade, my risk was around $47,500. I went with 50 contracts. I was obviously short, taking puts. This is the expiration and the breakdown of that. My total return on this trade was 108%, right? I'm one of those traders that likes to scale out as the trade is going in my favor. My average entry was around $9.50. Average exit was $19.80. But when you look at the executions, right, premiums went all the way down to $26.60. So because I was averaging out of that trade, right, the average exit is around $19.80, which gave me a net return of 108%. Now, trading SPX, right, when you guys are looking at SPX on a chart, for example, on TOS, you guys will notice that there's a lot of information that is missing from your typical chart. For example, there's no volume. It doesn't give us that much information in terms of the volume on that particular equity, which is SPX, right? Second thing is time and sales in level 2, which is not going to, again, show us much information. How do we trade this efficiently where we have enough information? Now, there's two other tickers that move very similar to SPX. There's SPY, which is ETF, and then there is ES, which is the futures. Both of these display that information, volume and time and sales. They're not gonna really show us that much of level 2, but SPY pretty much breaks down every single thing that we need to view to take this trade or to be able to trade Zero-DTE, trade SPY or SPX. If you guys take a look here, this is SPY's chart, right? 5-minute chart. We have a key level at 590, all right? So it's showing us that we come down, right? We have an opening range around 593 all the way down to 590. We pretty much bounce off of that 15-minute range. We're coming back to retest this opening range, right? Now, this is where I took that trade. So when you translate that into SPX, right, we had that retest on Thursday. The first time we took a trade here, and then the second time we took the trade here. So this trade was earlier. It obviously didn't generate as much of a return as it did on this push down here. This is the trade that we actually took, right? And you guys can see there's one factor that is telling us how aggressive that this thing actually pushes down, which is the volume, right? So again, when you go and look at SPX, it's not going to tell us that information. So going back to SPY, we can kind of see here that now we have much more relative information. We have that 590, which was acting as a magnet that day. So in order to trade SPX, for me at least, I like to look at a SPY because this gives me enough information to kind of make the judgment call of which direction the stock has more interest, okay? So that's the one aspect that we've kind of taken care of. Second aspect, which is very important, is the strike selection, right? This is something a lot of traders don't understand how to trade. If you have, right, a small account, and you guys can see here, these premiums were around $9.50 when I jumped in. If you have a smaller account, you're not going to be able to afford these particular premiums at that cost, right? So if your account size is, let's say, $3,000, you're probably risking $700 per each trade. So $900 is kind of out of your reach. And I'm gonna add something on here. This is where your strike selection plays a very important role in terms of how you take some of these SPX trades, right? The 58.90 at this particular time when we were looking to take this trade, right? This is the entry right here, and you can see that the stock price is well under 59.10. So the next strike, which is going to be 5900, right? And then followed by that is going to be 58.90, right? So when you're selecting your strike, one thing you want to remember is your goal should be to be as close as possible to at the money. Because once that strike becomes in the money, it starts to hold intrinsic value. Once it starts to hold intrinsic value, the theta and implied volatility, or IV crush, doesn't affect it as much as it would if it was out of the money. You have two options in this case. You go with 5900, which are roughly, I believe, $11, or you go with 5890, which is the next at the money contract. I don't like going in with 5895s or 5905s, those numbers in between those $10 increments, because they usually don't have the best liquidity, okay? Your strike selection is gonna play a major role in taking these type of trades. Now, because let's just, going back to that example of having your position size as 700, if you go the next strike down, which is 5880, right, which is right around here, this is probably going to be around $7. You can afford one contract. Now, the problem with selecting strikes further out is when the move happens in your favor and takes longer, right? So if we were to compare the 5890s, we'll use the purple line for 5890s and we'll use the red line for 5880s. Those are further out puts, right? During this sideways price action that you guys see, the purple strike selection is most probably going to recover the best even through these pullbacks. They're not going to lose value as much. So they might lose value, let's just say between 10 to 15%. Okay, then you have the 5880s, which are far out. Remember, right now we're understanding what happens here. So these further out of the money contracts, which are 5880, right? These are probably going to be losing anywhere from 20 to 25%, right? So when you kind of think about it, if you have a smaller account, and that means you don't have that much experience in the market, you're still trying to grow as a trader, you're learning the different types of strategies, you're just trying to understand how the market moves, taking a 20 to 25% hit and you see that number fluctuating, ideally is not going to be that great, right? So when we take these far out of the money contracts, they tend to lose value faster. On the contrary, there's also this fact that when you have a move like this, which is very aggressive, those far out of the money, they move just as aggressive in your favor, because when you think of time versus a target, and that target is achieved much quicker, right? Those particular strikes are going to move faster. So from comparing it to 5890s to 5880s, those far out are going to give generally a higher return. But the problem becomes these type of moves don't happen. So if you can't get consistent returns doing the same strategy again and again, and those returns are sometimes 5%, sometimes negative 50%, that number is not going to help you find consistency. So that's why your strike selection in taking especially Zero-DTE is going to play a very, very vital role, right? Your goal ultimately, if you are somebody who's trading these 5880s, should be that eventually I want to grow my account to where I can afford, right now I'm affording $7 per contract. I want to be able to afford $9 per contract so that I can go closer at the money, right? And this has a lot of benefits, which I'm gonna get into next, right? Because once that strike, which is closer at the money, becomes in the money, all we have to do is manage that trade. The further the stock moves away from our entry point, the longer we can hold that trade without actually getting faked out or stopped out. So when you're doing your strike selection, guys, if you have a smaller account, it's okay to kind of trade that further out of the money, but just keep in mind that you can't hold through this sideways price action for too long. You're gonna have to cut that trade as quickly as possible if it's not going in your favor, because the risk is way too high. Okay, your ultimate goal should be to be able to afford at the money contracts, because that's going to ultimately help you hold these trades for a much longer period of time. Like I mentioned earlier on, I'm not one of those traders that holds their full trade from here to here. There was a time where I used to do that, but now in the current market, I think as a trader, you have to adapt. And you can see here, this trade doesn't actually continue. And if I had held my full position through this pullback, I would have probably netted well under 100%, maybe 50% or 70%, which again is not bad. It's a great return, right? I don't want you guys to get the idea that, oh, he's complaining about 50% return. But I'm trying to tell you is if the trade has a potential for a higher return, our goal as trader is to be able to catch as much as possible. My goal for this trade review was to provide you guys with pretty much a masterclass on how to approach SPX depending on your account size. Because I feel like when you understand the difference between selecting different strikes, and again, this is just for the focus of trading Zero-DTE, you'll be able to make better decisions, right? When we don't understand why we're selecting a certain strikes, or why we're taking a certain trade, or why a certain strategy needs to have certain confirmations for us to take the trade, we as traders tend to make a lot of bad judgment calls. But once you understand, all right, if I take this strike, this is the risk. And if I take this strike, this is the risk, but it also has this reward, you'll be able to make better decisions, all right? So now going back to this trade, this was a very short trade. So going into the executions, right, I got in at $9.50. I waited for this candle to close in under 59.05. And my starting stop loss was roughly around 59.08 to 59.10. So if it had closed above that on the 5-minute, I would have most probably closed the trade. I'm very good at respecting my stop loss because I've lost so much money in the past changing my stop loss when the trade goes against me that now, especially with SPX, I don't take any chance. The moment I see that the trade might be going against me and it's hitting my stop, I'm completely out. One more thing I want to mention about in this so-called masterclass is when you are trading SPX, you can have slightly wider stop loss, but that stop loss should come from some sort of a cushion. So like I mentioned earlier on, I took a trade here as well when we broke down earlier around 10 a.m. and this netted us, I think, roughly around 40%, right? The premiums didn't move as great as they did here. So I had a pretty solid, I think roughly around $8,000 of profit from earlier on that I was risking here, that if I was wrong, I don't mind giving that profit back. So based on my stop loss, I would have been down roughly 4,000 on the day, giving back that 8,000 plus another 4,000 of my profit if it had closed above my stop loss. And when you have a cushion and you're trading SPX, right, you're not really focused too much on that profit. You're focused more on the price action. The reason why most traders, when they trade SPX or Zero-DTE, they don't do well is because they don't trade with a cushion. They literally just trade thinking that SPX or Zero-DTE has to be traded the same way as every other setup that they trade, which is not true. You need to have that time versus the target part in your mind. We need SPX, we need SPY to be very volatile in our direction. So for calls, we want to see a push up. If we're trading puts, we want to see that push down. The more aggressively the stock moves away from our entry point, the better the return is going to be. So if you guys see here, we consolidated for a bit. There was a tug of war between buyers and sellers, and this is where the tape comes into play, which is level 2 in time and sales. And going into this test, that we saw a little bit of an imbalance happening on the tape, leaning more towards the sellers being more aggressive, because every time we pushed above, I'll go over SPY because that's what I was kind of paying attention to. So every time we got over this 589.50, sellers came in and they pushed us right back below. So that gave me the confidence to hold this trade and not jump out, because if you were taking SPY, your stop should be one of these key levels, which is roughly around 590. So translating that on SPX, that's roughly around 59.10, right? The moment that imbalance got more aggressive towards the seller side, sellers got aggressive. We got this very aggressive push down. We went from 589 all the way down to 586.50, right? And this is where those premiums actually jumped up very well. So they went from 950 to the first scale out, and this is where it broke low of the day. I got out at $13.80, which is roughly around 30% of my position. And I mentioned this in the previous trade recaps as well. I personally like to scale out 30, 20, 20, 30. So a minute later, I see the premiums are now at $19, right? So I scaled out another 20% at this point, which I was out half of my position going into this point, and I took out a little bit more at 22.10. So when they peaked here at 26.60 at the low of the day, I jumped out, closing pretty much 10 of those remaining contracts, and I had 5 left. We started to pull back, and as the stock is moving down, right, we're obviously increasing our stop to protect our downside. We don't want to have, so if your starting stop loss was 59.10, you don't want to leave that stop loss. As the stock moves in your favor, increase that stop to previous key level. So when this candle came up very aggressively and closed over 58.80, which was our new stop at this point, we closed the trade, took the final exit out at $20.80, which netted roughly $51,500. Right. This is something a lot of people focus on, which is this $51,000. They think that number, wow. What you should be focused on is the percentage, right? Percentage is going to be your strength in terms of becoming a good trader. You should be able to risk 500 and make a certain percent back. Don't ever focus on the dollar value. Focus on the percentage value. Kind of helped you guys. It was a trade review, but I wanted to throw some extra information in there to help a lot of you guys who've been asking about how to trade SPX. Comment below what else I should cover, or maybe I'll just cover a full masterclass on how to trade SPX, from strike selection to volume to liquidity, what to look for on SPY. Leave your comment below, and I'll see you guys in the next video.